Hi, welcome back. In my last session, I talked about banking as a business, drawing a divergence or a differential between good banks and bad banks. And at least in the simple framework that I created, a bank that has access to sticky deposits, most of which are non-interest bearing, that then takes that capital and invests it in loans and investment securities where it earns an interest rate higher than what it needs to make given the default risk, is a good bank. And to add to the goodness, if it has built a buffer up against failure with more equity and more tier 1 capital, all the better. So dividing banks into good banks and bad banks is not that difficult. In this session, I want to focus on a different question. What banks are good investments? Good banks are not necessarily good investments, and bad banks are not necessarily bad investments. If you're mystified by that, it all depends on the price. If a good bank is priced as a great bank, paying that high price will effectively set you up for disappointment. If a bad bank is priced as an abysmal bank, getting it at the bargain basement price might actually make it a good investment. So I want to focus on valuing and pricing banks in this session. I'm going to start with valuation. I like valuing companies, and I like challenges in valuing companies. I like valuing young companies, difficult to value companies, and banks are a different breed when it comes to valuation. Let's see why. When you think about valuing a traditional company, you have two choices. You can value the entire business, or you can value just the equity in the business. Let's start with equity valuation. It's a little more intuitive. When you value the equity in a business, you look at the cash flows you as equity investors get after everybody else is being paid, after interest payments, after debt payments, cash flowed equity, and you discount them back at a rate of return you would demand as an equity investor given the risk in the equity or cost of equity. Cash flows to equity discounted at the cost of equity gives you the value of equity. What's the alternative? You can think of lenders as capital providers, just like equity investors are. You can look at the collective cash flows that equity investors and lenders get. It's a pre-debt cash flow. It's still after taxes and after reinvestment, but before debt payments. And you discount those cash flows back at a weighted average of what lenders want, which is the cost of debt, and what equity investors want, which is the cost of equity, which in corporate finance is the cost of capital. Cash flows to business, pre-debt cash flows, discounted back at the cost of capital gives you the value of the business, enterprise value, value of operating assets. Now with typical companies, you have the choice. With banks, you lose that choice. And here's why. With a non-financial service company, debt is a source of capital. When an automobile company borrows money, it's because it wants to use debt as a source of capital. You're saying as opposed to what? For a bank, debt is more raw material than capital. What does that mean? When a bank borrows money at 3%, it hopes to make money by lending that out at 4%. In other words, the essence of banking is raise capital from depositors and lenders at a low rate and lend it out at a higher rate. If debt is raw material, we can no longer think of it as source of capital like we did in traditional valuations. Where does that leave us? When you think about valuation in banks, it has to be equity valuation. So if you're doing an intrinsic valuation, it has to be cash flows to equity discounted at the cost of equity. We'll talk about the challenges you might run into in even doing that, but that's the only pathway. When you're pricing banks, the only multiples you can use, pricing metrics, have to be equity pricing metrics, PE ratios, price to book. I mean, if you see somebody pricing a bank with an EV to EBITDA multiple, you already know that that person has lost the script. So let's talk a little bit about equity valuation, at least in its most generic form. If you ask me to do an equity valuation of a typical company, I'm going to compute the cash flows left over after every conceivable need has been met. So I'm going to start with net income, which is the measure of earnings to equity investors. I'm going to add back depreciation and subtract capex. Think of that as investment in long-term assets. I'm going to subtract out a change in working capital. And to the extent that I'm repaying debt or raising debt, I'm going to include that in my cash flows as well. So cash flows to equity are cash flows left over after every conceivable need has been met. If you ask me to project out that number, I'm going to project out the net income in future years, and I'm going to project out how much of that net income I need to put into reinvestment, which is net capex and change in working capital, with the offset that some of it might come from debt. That gives me my expected free cash flow to equity. I project that out for as long as I have high growth, and at the end of the period, I assume that at some point in time, my cash flows start to grow at a steady state. a rate I can sustain forever. What does that allow me to do? It allows me to put a closure on my equity valuation by computing a terminal value of equity. Now, the perpetual growth version of it, you estimate cash flows 1 year out, the free cash flow equity in year n+1, and you divide by the difference between the cost of equity and the growth rate. Now, all of those cash flows get discounted back to today at a cost of equity, a rate of return that equity investors demand in the stock. And what you get as a present value of those cash flows and terminal value is the value of equity in a company. Simple enough, right? But let's say you tried to estimate this for a bank. Estimate what? Free cash flow equity. Net income. That's easy enough. You can get that. But the rest of the items in that calculation, capex, depreciation, working capital, and of course, we talked about the slipperiness in defining debt, become almost impossible to define. So you say, how did people value banks? Well, the easy answer to that is they gave up on estimating free cash flows to equity because they said, I can't get capex, I can't get depreciation, I can't get working capital. You're still saying, well, how did they value banks? You can't just give up. Well, they fell back on the dividend discount model. What are dividends? That's what banks pay out as cash flows to equity. And in effect, it simplifies valuation because you're no longer making estimates of what's being reinvested. You're making estimates of what's being paid out. So you start with the base year dividends and then you project out expected dividends in future years. What does that require? Your net income and a payout ratio. And at the end of this high growth period, you do what you do to free cash flow equity, but now you do it in terms of dividends. You discount the dividends and the terminal value of equity obtained from dividends in perpetuity at the cost of equity. You have a dividend discount model value for a company. You can already see why analysts fell back on the dividend discount model. And in fact, banks were the last remnant for the use of the dividend discount model through much of the last 30 or 40 years. But when you use the dividend discount model, are you making assumptions? Yes. You are making implicit assumptions, and the two key implicit assumptions you're making. One is that banks are run by sensible people. You're saying why? Because you're assuming that what banks pay out in dividends is what they can afford to pay out. You're assuming that a bank that is undercapitalized, that needs a capital, will not pay out dividends. That's what sensible people do. So you assume that banks are run by sensible people. Second, you're assuming that banks are regulated and the regulatory framework actually works at keeping banks from doing things that can blow up the bank, take on too much risk, and expose themselves to dangers that will bring the bank down. Those are the assumptions, and until 2008, I'll make a confession. I made those assumptions. I used the dividend discount model to value everything from Citibank to Goldman Sachs, making the argument that banks are run by sensible people and the regulatory framework works. I might have been naive, and as I said, my days of innocence came to an end in 2008, when we woke up to the realization that both these assumptions were off. We found that banks were run by some of the least sensible people on the face of the earth, paying out dividends they couldn't afford to. And we also found out that the regulatory framework doesn't always work. There are huge holes in it. So starting in 2008, I started thinking about estimating potential dividends for a bank. Now you're saying, well, we already ruled that out. You can't get net capex and change in working capital. You're right. If I follow the path of estimating free cash flows equity that I do for a traditional company, I'm going to run into dead ends. So here's what I decided to estimate as reinvestment in a bank. I said, look, for a bank to grow and survive, it's got to maintain regulatory capital. The investments it needs to make to keep that regulatory capital sustained or growing is the equivalent of the reinvestment for a bank. What does that mean? A growing bank will need to reinvest more in regulatory capital than a stable bank. An undercapitalized bank will need to reinvest more than an overcapitalized bank. To estimate free cash flow equity, then I take the net income, I subtract out the investment in regulatory capital, I come up with free cash flow equity. It's potential dividend. Essentially, I'm replacing actual dividends because I don't trust those numbers with potential dividends. They say, what does that gain us? First, it releases constraints that come with dividends that you don't have with free cash flow equity. Like what? A dividend cannot be less than zero, right? So you could have the most undercapitalized bank in the world in horrific trouble, and you can't go below zero. With that same bank, if you ask me to estimate free cash flow equity, Because they need to invest large amounts in regulatory capital, I can get a free cash flow equity that's negative. What does that mean? I'm building in the expected dilution that's going to happen because they need to raise fresh equity. And by tying cash flows to capitalization, I also open the door to being able to adapt or adjust my cost of equity across banks, something which I had very limited room to do with the dividend discount model. An undercapitalized bank should have a higher cost of equity than an overcapitalized bank. There's a higher failure risk. It opens the model to be more adaptable and flexible. Now, it sounds incredibly abstract, so I'm going to try this out on a bank. The bank I'm going to pick is Citibank. And once we get to the pricing section, after this section, you're going to see why I pick Citibank as my bank to value. So let me set up the structure. Citi, coming into May of 2023, was a bank that had acquired a reputation among investors for not being that good. It was a slow growth, stodgy bank that was earning much less profitable than its more successful counterparts. In fact, the bank that Citi was, if you think about a counterpoint, it's compared to is JP Morgan Chase. JP Morgan Chase is the star, Citi was the dog. It's a bank that over time had ended up with a growth rate in its risk-adjusted assets of about 3%. And I'm going to assume that it can maintain that growth rate. Had seen its return on equity drop to about 8.78%, well below its cost of equity. And at a Tier 1 capital ratio, which is pretty healthy. So the good side of Citi wasn't a risky bank. It was just boring, not that profitable, and slow growth. So in my valuation, here's what I assumed. I assumed that it would stay boring and stodgy, and that the improvements, if they happen, would be very small. In particular, I assumed that return on equity over the next 5 years would improve from 8.78% to 9.5%. You're saying, where do you get the 9.5%? That's actually Citi's own return on equity on average over the last 5 years. In effect, I'm assuming that over time they would recover to an average return on equity that they were able to maintain over the last 5 years. Now, to show you how negative the story is, the cost of equity that I gave Citi was 11.67%. That sounds oddly precise. You're saying, where do you get that number? Well, I actually backed into it. I didn't use any risk and return model. I backed into it by looking at how the largest banks were being priced. So you look to the bottom, I take you through the process. Start with the price to book ratio for the 25 largest banks and the return on equity at these banks. Now, I'm going to assume that if you're looking at the 25 largest US banks, you're looking at a pretty mature sector. And the growth rate is going to be pretty close to the growth rate of the economy. Drawing on a practice I've used before, I've set that growth rate equal to the risk-free rate, 3.3%. Now, when you think about the drivers of price to book for a company is driven by and I'll come back and back this up, is driven by the return on equity banks can earn on their investments and the cost of equity. A bank that roughly earns its cost of equity should be trading at a price to book close to 1. So I took the 1.04, which I could estimate by looking at what banks were priced at. The actual return on equity for these banks was about 12% and used a growth rate of 3.3% and solved for the cost of equity. I'm reverse engineering from the pricing of banks what the cost of equity for a bank is. Came up with 11.67%. Return to my story. Even with my return on equity improvement Citi, I'm leaving them at 9.5%, well below their cost of equity. This is not an uplifting story. It's a story about a bank that's slow growth that'll never get to a point where it can earn its cost of equity. Now, even with that very depressing story, here's what the numbers look like. First, the mild improvement in return equity translates into higher net income over time. Remember, my overall risk-adjusted assets are growing only 3% a year. So my net income improves over time. Each year, I do push up my Tier 1 capital because one of the things I think is going to come out of the crisis of 2023 is slightly stronger capital ratios, so from 14.8% to 15%. An already conservative bank in terms of Tier 1 capital is going to see that rise over time to 15%. That increase in Tier 1 capital translates in investment in regulatory capital. And you can see the investment in regulatory capital play out as my reinvestment each year. So what you see as free cash flow as equity, 10.7 billion, are roughly speaking the potential dividends I see from Citi over the next 5 years. What happens after year 5? Bank goes into steady state. I estimate a terminal value of equity. I discount them all back today at 11.67%. The value that I get for Citi's equity on an intrinsic basis is 134 billion. Divide by the number of shares, I get a value of about $68.6. Stock was trading at 44.3 on an intrinsic value basis. The stock looks like it's undervalued by about 32%. It's an intrinsic valuation. Have I made assumptions? Yes. But none of them are assumptions where I'm breaking Citi out of the mold. It's essentially a fairly depressing mold. Low growth, returns below cost of equity. File that away, that's my intrinsic valuation. Let's talk about the pricing of banks. Now, I've long drawn a contrast between value and price. Value, as I've long argued, comes from cash flows, growth, and risk. And when you use a discounted cash flow model, you're effectively trying to compute the intrinsic value of equity in a bank, which is what I just did. But there's another approach I could use. I could look at how people are pricing other banks and extrapolate from that, based on what other people are paying for similar banks, to what I should pay for a particular bank. That's pricing. And as I argued earlier, because of the way in which banks are structured, the only pricing multiples you can use are equity pricing multiples, PE ratios, and price to book. And price to book ratios are usually, widely used in banks for two reasons. One is, unlike a traditional company where book value of equity often means very little, and that sounds like a weird thing to say, but 1 in 9 companies in the US have negative book values of equity. Nobody cares. Why? Because book values of equity are accounting numbers and often they lose connection to reality. With a bank, book value of equity does mean something because it becomes the basis for regulatory capital. A bank cannot survive with a negative book value of equity. In fact, safety capital ratios historically have defined in terms of book value of equity. So for a bank, book value of equity actually has operating consequences. The second is, much as there's talk of mark-to-market, the sector where mark-to-market is its deepest roots is banking. So the book value at a bank actually is closer to a fair value than pretty much any other company. I know that there's been a bit of controversy with what happened at Silicon Valley Bank and holding to maturity and how some assets don't get marked up. But the reality is more assets at banks get marked up to market than in any other sector. So book values actually mean something. So price to book ratio is actually widely used. So I'm going to start by looking at what it is that drives the price to book ratio. I actually used this to get the implied cost of equity, so I'm now reverse engineering how I came up with that equation. Now, the easiest way to see what drives the value of equity in a bank is to go back to a very simple intrinsic valuation model. I know we're on pricing, but stay in there with me. My simplest equity valuation model is a stable growth dividend discount model. Take expected dividends next year by cost of equity minus growth. It's called the Gordon growth model, oldest discounted cash flow model in use. Let's say I divide both sides of the equation by the book value of equity. I'm allowed to do that, right? And then if I replace my growth rate with what's called a sustainable growth rate, which is the retention ratio times return equity, that equation you see for the Gordon growth model can actually be simplified into an equation for the price to book ratio. Now you can work out the algebra to see if I'm right, but the price to book ratio for a mature bank should be a function of two things, the return equity at the bank and the cost of equity. It's actually an incredibly powerful equation because it says that a bank that is expected to earn roughly its cost of equity should trade at roughly book value. A bank that's supposed to earn more than its cost of equity will trade at more than book value. A high price to book exceeds 1. And a company that expects to earn less than its cost of equity should trade at less than book value. So we're going to come back and talk more about this, but you can see what drives price to book ratios. So with that insight, let me take a look at price to book ratios for banks in the US collectively going back over the last 20 years. It's been an eventful 2 decades, but the first 3 or 4 years in this graph are glory years. Remember the days of innocence, where banks were viewed as safe and the regulatory authorities actually did their job? You can see the price to book ratios reflect that. And then came the year of reckoning, 2008, 2000. And you can see in those years, the price to book ratio drops below 1. And you can say that makes sense. The return equity drops, to substandard levels. So collectively, 2008 caused a collapse in both price to book and return equity. Since then, though, banks' return on equity has improved almost to levels that you saw before 2008. But guess what? Price to book ratios have struggled to get back to those pre-2008 levels. In fact, by May of 2023, the price to book ratio for banks was close to 1. Banks were being priced on the expectation that they would deliver returns on equity collectively roughly equal to the cost of equity. I use that line of 1 as a marginal line, basically arguing that when banks fall below that the implication is investors are expecting banks to earn less than the cost of equity. So over time, you've seen that banks have become less richly priced. And this is during a period when the rest of the market has been soaring. Interest rates are low, PE ratios are up, price to book ratios, that banks have stayed stagnant in terms of price to book. Now, for some value investors, that has meant that banks are being underpriced. And I know many value investors who've loaded up on bank stocks over the last 10, 15 years because they feel it's a contrarian view. Now, that is entirely possible that banks are, and this is especially as returns on equity have improved. Value investors said this makes no sense. The price to book ratio should go up as the return equity goes up. Now, that might be true. And their reaction, their investment may be a good one. But we need to rule out some fundamental reasons why price to book ratios might never go back to what they were pre-2008. The first is that maybe banks now are more risky than they were 15 years ago. At some levels, though, that doesn't seem to have much justification. The Tier 1 capital ratios, regulatory capital at banks now is higher than it was 10, 15, 20 years ago. Even if you take book equity to total assets, which is kind of an old-fashioned measure of safety capital, it's true there was a drop-off in 2020 and 2021, the COVID years, but even on that number, you've sustained your book equity as a percentage of total assets. So banks have become more risky, at least on the capital ratios, it's not showing up. The second is maybe banks are less profitable now than they used to be. So I looked at a couple of things. One is I looked at the interest earned on loans and investments versus interest paid on deposits and the spread. The bigger that spread, the more money banks are making. Again, if you take a look at the last decade, there's a 2020 and 2021 drop because, again, the COVID drop. But you take those 2 years out, it doesn't look like the spread has changed. So even as interest rates have gone up and down, banks have been able to maintain their spread. In fact, you could argue that the same spread at a much lower interest rate is worth more simply in present value terms. So it's not that. So banks have not, at least in any visible way, become more risky. Banks are not less profitable. There's a third possibility, which is that the banking business is being disrupted. By whom? By both upstarts in the fintech space and existing companies like Apple deciding that they were going to inch their way into banking. And you can see this in almost every dimension of banking. There's more risk than there used to be. We talked about how deposits have become less sticky as investors and customers have more choices. How increased competition for the loan business from non-banking entities is making those businesses less profitable. All in all, you can see a collection of storms gathering, and perhaps investors are looking and say, maybe this business is never going to be the kind of business it was before 2008. So as we look at banking, that's something to think about. It's a less attractive business than it used to be, and perhaps banks will be lucky to make more than their cost of equity, and those banks that do should be valued even more. So that's banking across time. The other way you can look at the pricing is to look across banks at a point in time. So I start by looking at price to book ratios for publicly traded US banks at the start in May of 2023. And you can see the distribution, and I've actually compared it to the numbers at the end of 2022, separated by 5 months. And you can already see that this crisis has had an impact across the board. Every single number is lower now than it was at the end of 2022 by about 25%, 20%. There's been a big drop in price to book ratios across the board at banks. And that you can understand why that's happening. There's more fear in the air. Now, perhaps those differences you see in price to book across banks can be explained by differences in profitability. Every multiple has what I call a companion variable. The companion variable for price to book is return equity. So you expect high return equity banks to have high price to book ratios and low return equity banks to have low price to book ratios. Now, of course, to give you some perspective, I actually looked at returns on equity across banks. And it's a sector where the numbers are very tight. In other words, you look at software companies, the margin differences are huge. In contrast, 50% of banks in May of 2023 had returns on equity between 9.4% and 14.8%. I'm sorry, in 2021 had returns on equity between 9.38 and 14.8%. End of 2022, that difference had narrowed between 9.2 and 13.8%. It's a business where there aren't too many outliers. There's a lot of bunching up around the middle, but there are differences in return equity. As I said, the link here is between price to book and return equity, and high return equity companies should have high price to book ratios, and low return equity companies should have low price to book ratios. One way to test this hypothesis is to run what's called a scatter plot. We take price to book ratios and returns on equity. And broadly speaking, the hypothesis holds. If you look across both graphs, higher price to book companies tend to have higher returns on equity. Now, before you celebrate, though, take a look at the R squareds in these two graphs. They're in tiny letters. You might not even be able to see them. You can see that those numbers are not huge, 11% and 14%. A lot of the variation cannot be explained by returns on equity. But you can see the first step in explaining difference in price to book and return equity. Incidentally, these scatter plots give you a very simple way to find cheap and expensive. May of 2023, the two lines I've drawn reflect the noise in the data. They reflect confidence intervals. The banks that fall above are your overvalued stocks. The banks that fall below are your, overpriced stocks and underpriced stocks. So it's a good way to think about it. Now, incidentally, it's worth noting that the R squared, the proportion of the variation in price to book that I'm able to explain with return equity, has decreased fairly significantly from 14 to 11% over a period of 5 months. You're saying what happened? The crisis happened. During crisis, this is exactly what tends to happen. Is there's a rush for the doors. People sell banks, just because they want to get them out of their portfolio, and you see that reflected in a lower linkage with fundamentals. It's an opportunity for investors, but it's in fact a consequence of the crisis. Incidentally, if you're fond of visual presentations of mismatches, and after all, that's what I'm looking for, right? I'm looking for a company with low price to book and a high return equity. I can bring in a third dimension. It is true, I want a company with low price to book and a high return equity, but if I can, I'd also like that bank to be less risky, have a higher Tier 1 capital ratio. Now, I know this can make you dizzy, but I've created a 3D scatter plot with price to book on one axis, return equity in the second one, Tier 1 capital ratios in the third. Trying to be helpful, I've listed out where in this cardboard box you're going to see your biggest bargains. Your most undervalued stocks will have low price to book, high return on equity, and a high Tier 1 capital ratio. It'll be right down here. So, I think the SVB Bank is the bank that you see closest to that most undervalued end. At the other extreme, companies which have high price to book, low return on equity, and a low Tier 1 capital ratio, which would put you right there, are your most overvalued companies. I know that, for some of you, 3D scatter plots don't quite do it, but I'll give you a simplistic way in which you can do this without, But I do like to be able to see my data, and this is one way to see it. So I thought I'd use what I've learned about price to book and return equity in the context of looking for bargains among the 25 biggest banks. So here's what I'm looking for. I'm looking for a mismatch. I'm looking for a stock that is price cheap. So I'm going to start with the price to book. Say I want a low price to book. I want that bank to not have a low return on equity, right? Because that would explain away the low price to book. So I want a bank with a high return equity that's earning a solid spread, a high interest spread, but spread between what it earns and what it pays out. So return equity and interest spread measure profitability. We talked about deposit growth being a proxy for stickiness, that faster growing banks have less sticky deposits. Given that 2003 is the year of the sticky deposit, I want a low deposit growth in my bank. I don't want a bank that's grown 30% a year because that puts me at risk. Do I want a buffer built into my bank? Absolutely. I want a high tier 1 capital ratio because that makes my bank safer from a regulatory standpoint. And we do know that one of the concerns in May 2023 is the fact that as interest rates have gone up, there are investment securities on banks' balance sheets that will get written down, and to the extent that they're held to maturity, those losses are not being disclosed. So I'd want a low percentage of securities held to maturity. I want them held for sale, which means at least I get an honest picture when I look at the balance sheet. Finally, I also look at the dividend yield. Argument here being high dividend yield companies, you collect your returns in cash, they're safer in some way than low dividend yield companies. So those are pretty straightforward intuitive measures. I computed them for the 25 biggest companies. And you're saying, what are the red and the green numbers? Here's what I did. I computed the median value for each metric. So let's say price to book, the median value is 1.04. I took the median and any number higher than that. Remember, you want a low price to book for a cheap company. I made any company the price to book of 1.04 or higher into a red number. Danger. The green numbers here indicate cheap relative to the median. I did the same thing with return equity. Here I took the median return equity 12% for 2022. And then I picked every bank with a return equity greater than 12%. And those are the green numbers. That's good. And every bank with a return equity less than 12% into a red. And 12% basically to reflect the fact that that's low profitability. So you kind of get what I'm doing, right? With each metric, given what we did in the previous page, I'm breaking the metric down into under, over, based upon the median as my dividing line. And then I resorted the banks based on price to book, because that's going to be the central pricing factor. What am I looking for? I'm looking for a bank with a low price to book, which is profitable, high return equity, both most recent year and average, a high interest spread. I would like it to have low deposit growth because it makes deposits less sticky. And I want it to be well capitalized, a high tier 1 capital without the danger of a write down by having a low percentage of securities held to maturity. And on top of that, I'd like to have a high dividend yield. I'd like all greens all the way across, right? Now the bad news is there are no all greens. The bank that comes closest to being cheap is Citi. It has a price to book of 0.50. And it comes with a solid tier 1 capital, a pretty high interest spread, and low deposit growth. Citi's biggest weakness is its return equity, which is below the median. And that should make its price to book ratio less than 1, but not 0.5. In other words, it should be cheap, but not this cheap. So Citigroup looks like the most, and just to give you a contrast, let's take the star of these 25, JP Morgan, right? You look across JP Morgan and it scores well on return equity. It does clearly much more profitable than the typical bank, has a great tier 1 capital ratio, it's a good spread. You say, why not buy JP Morgan? Because you'll be paying 1.53 times book value. Given a choice between buying Citi at half of book value and getting this boring bad bank, and paying 1.53 times book value and getting a bank that everybody thinks is a star bank, I take the former over the latter as an investor. So when you think about looking at a sector, this is a neat trick. Compute the median, highlight the numbers into red and green based on, and then see if you can get that perfect combination of a mismatch. A company that's cheap without any good reasons for being cheap. So you can pick your favorite bank, Wells Fargo, Bank of America, and see how it plays out. But it's not rocket science. You can do this for regional banks and see if there are any banks that might be worth going after now. But it's a pricing judgment. Now as I look at Citi and I can see it is cheap on a pricing basis, you know what makes me feel more comfortable? The fact that I did an intrinsic valuation already. As an investor, I think it's nice to have an intrinsic value backing it up. But as an investor, there's nothing that prevents you from also looking at pricing. Citi seems to be both undervalued and underpriced. And that makes me more comfortable investing in it. I know for a lot of people, the choice is, do I want to value something or price it? My argument is, why not? No, my response is, why not do both? No. So if you were to think about what makes this session different from the last one, my last one was focused on good banks versus bad banks, good companies versus bad companies. This one was focused on good investments versus bad investments. And to make that judgment, price has to enter the decision process. If you don't consider pricing, then I don't see how you can be an investor. So as you look at the investment side, your judgment focus shifts away from, hey, what's the best bank, the best company in this mix, to what's the best priced bank, the best company here. I hope you found the session useful, and I thank you very much for listening.